Welcome, everybody. Trends with Friends live. I think this is week 3, our new home. Excuse me, live on the internet.
Bless you.
Bless you. Bless everybody here but Phil. Live on the internet, on the most heavily indebted, worst bank deal of all time, Twitter and YouTube. Welcome, everybody. JC over there on the far right, looking very... He's got some baby powder on his forehead. He's looking fresh. JC hiding out from his family for
No,
this
I'm
is the
looking.
third.
I'm feeling good. Good times in Toronto.
You look good.
Howard.
Yeah, Toronto's
Bullish
overrated.
Toronto.
Oh, please.
So bullish.
Okay, we'll get into that if we have time. And then hiding out from his family
Hater.
for
What
the
a hater, Toronto. Love Toronto.
for the 4th straight year. Phil Perlman.
Aren't you from Toronto, Howard? Isn't it your hometown?
The best people are from Toronto and have since left. But Phil in his basement. Michael Parekh, whose background continues to improve, and he's got probably some secret early stage NVIDIA glasses on. Michael Parekh, our AI master in Houston, I think. And then I'm here in Coronado. That's about 100 yards away is the beach, and you can see all the people storming up from Nicaragua, as usual, and Mexico. Don't be scared if you see a lot of activity behind me. All right, we got a busy agenda. I saw today cyber all-time highs, hack breaking out. We got Eli Lilly breaking out. We've got we survived the bear market of 2024. And Alibaba, wanted to check in on China. We've got, is the US dollar breaking down? Obviously, gold's been running, so is the US dollar breaking down? We have an AI Corner with Michael Parekh, a big AMD deal this week. He can break that down for us. And then we've got trends with no friends. I do want to double click on what I was riffing on last week about venture capital and how that's related to the market. But and then most importantly, next week, Phil, JC, Michael, we have a NVIDIA's earnings on the 28th. So we're going to have a special kind of on and off programming for the day that Phil is putting together with the Law and Max on our production team. Live conference call on StockTwits and pretty much a whole day of madness. I mean, NVIDIA is pretty much the new Tesla of this era, where people just can't stop.
Like it's the new Apple. Like it's almost more like the new Apple than more.
But
Tesla.
in terms of attention, Elon Musk and Jensen, it's like for all the attention Tesla gets, good and bad, Elon, Jensen gets about. So let's start with I survived the bear market. There's a lot going on in the market. I don't know if that was a bear market. Would be the shortest one in history. The semiconductors that were leading were down a quick 22%. VIX hit 60, and then here we are. What JC or Phil, walk us through this?
There's no bear market about. I don't know if anybody calls what is going on in this market a bear market. They need to check themselves into a mental institution, because
I've thought about it. I do Google that. I was being more sarcastic, right?
No, I know it, but there are people saying that. Yeah, I'm not saying you specifically. There are people saying that. I think you have to be absolutely insane. Think about what these semiconductors have done. First of all, going into a couple of months ago, the semiconductors index off just in a year and a half tripled just in a year and a half. So yeah, it's not going to go straight up forever. It doesn't mean it's not an enough trend. It doesn't mean the world's falling apart, right? Pearl Dog, like these things literally tripled in a year and a half.
I mean, here's the joke, and that is that the market, we had this market event, everything tanked, and then it just came right back. And so, hostile charts on StockTwits. Larry Thompson posted this other chart of the S&P 100 equal weighted that we're back at all-time highs there. And now JC's going to take us through a few of the sectors that are making all-time highs and what's going on there. Go ahead, Michael.
And I'll just add looking at it from a secular point of view. We're looking at these charts, etc., but just on the fundamentals in terms of chips. it is, when you look at it quarter by quarter, we're going to see NVIDIA next week. The momentum of the demand of for all chips, not just GPUs, but data center equipment, memory chips, etc. The momentum is extraordinary. TSM just reported their numbers a few days ago. Over 50% of their business is now what they call HPC, high performance computing, and it's growing over 20%. So, and they're 60-70% of the chips that are going to be made on the planet. So we can see this freight train coming. It's not a abstract thing now. And given the time cycles involved, we can be relatively assured that these demand curves are going to be okay for at least 3-4 quarters. So I just wanted to point that out as we look at the charts. On
So
chips.
the market didn't crash, the bull market didn't end, and everybody who did absolutely nothing is winning again. JC, your NYSE Composite Index chart.
Yeah, I mean, listen, you look at the most important stock exchange in the world is the New York Stock Exchange. I mean, nobody's going to argue that. Like, you've got all the global companies trade on the New York Stock Exchange. You've got a lot of cyclicals. You know, even compared to something like the NASDAQ, like there's no energy in the NASDAQ or financials or real estate or industrials or materials, right? So the NASDAQ's not the market. The New York Stock Exchange is the exchange where all these stocks trade. This index that's composed of those stocks is making new all-time highs. And if you go to the one above that, it's the Dow Jones Industrial Average. This is the world's most important index, also making new all-time highs. The S&P 500 on an equally weighted basis just hit new all-time highs. Like mathematically, it can't be 7 stocks if the equally weighted S&P 500 is making new all-time highs. If you scroll down a couple of charts, you've got the advanced decline line on the Dow Jones Industrial Average and the S&P 100. By the way, the fact that we are 10 minutes into this podcast and we've already talked about the S&P 100 twice has to be a new record. Nobody talks about the S&P 100. We got the AD line here making new all-time highs. Same thing with the Dow Jones Industrial Average. And then here's the thing. Go to the next one. You've got more stocks going up, right? Look at the expansion in stocks making new highs. This is the NASDAQ Composite, but you'll see the same thing in the New York Stock Exchange Composite. More stocks are going up, not fewer, more. So if you can't tell me that things are getting worse if mathematically things literally are getting better. Now, if you go to the next chart, you can see the things getting worse. The beauty of the market is that mathematically, you can't have a bear market or a correction of any kind without the prices of stocks falling. We all know that, and we all agree. So if we know that, shouldn't we spend some time looking and seeing how many stocks are falling in price? Yeah, obviously. And the answer is not many. Not many at all. Look at the new 1-month lows list. Literally, this is on the New York Stock Exchange. So these are the most important stocks. This is the universe. Look at the new 1-month lows list. Couldn't even exceed the April levels. Like, couldn't even get more lows than in April. Like, really? The VIX fucking tripled. And you couldn't even get more lows than, right? And then look at the 3-month lows. Like, nothing. Like, no expansion in new lows at all. So how do we know if we're in a correction? How do we know if this is a bear market or any kind? Just correction. You're going to see the prices of stocks falling. We haven't seen that. Like, you'll see it. You'll know it when you see it.
I think, again, I'll go on to my riff. This doesn't count as my venture capital riff. But I'm just going to tease here. The reason you're not seeing the expansion in new lows here is you're seeing a massive expansion in bankruptcies and new lows in the private market. So again, there's been this misallocation of capital, which is like stocks scare people because, valuations are rich and because they don't understand cybersecurity. They're used to buying the Magnificent Seven, not Eli Lilly. They don't know how to look at the market this way, right? They've had a Robinhood mobile app that has 10 names on their homepage. They haven't had the luxury of learning the markets from a desktop, right? Which I've talked about for years. We're going to have to move back to a desktop language. If people really want to learn if people want to learn how to invest.
I like that thought process. I like what you're saying there.
Well, no, I'm just saying mobile web, and there's so much to talk. Mobile web was about taking the world and condensing it to 5 trends on Twitter. What's trending on Twitter? What's trending on TikTok? What are the 5 stocks that I have to own? Indexing. And true investing is truly understanding money movement in the world. Doesn't mean you have to, it's a language, right? It's like learning any good language. There's slang and text language, where you can get away with like not speaking English basically, but getting your point across. And then it's the language of it, which is the beautiful language of English and conversation, which people have gone away from. And the same thing's going to have to do the
Roman, can you
market for.
touch on this? I really like
Yeah.
what Lindson's saying here about the back to the desktop. Like, you got your mobile stuff, and I could do 99% of my life on mobile.
You can.
But when it comes to market analysis, I'm at the desktop. I'm not doing that on mobile. Like, the only reason why I can do a lot of stuff on mobile is because I have the charts engraved in my head. So I look at a prices and it just, line go up, line go down, but I know where the line has been. But it all comes back to the desktop. Roman, of all people, I would love to hear your thoughts on what Lindson's saying, because I really agree with that.
I think it's absolutely true. And there's a number of great tools out there that are perfect for doing this type of analysis and walking through the market. When JC, when you just say it's just math, it reminds me of how simple all of this is. But it takes work. It takes looking at the whole market. It takes doing your due diligence. It's simple, but I know this is a cliche, but it's simple but not easy. But there's all of this data is incredibly available all over the place. All you have to do is take a look at a Koifin or a StockTwits. It's so simple. Or just look at JC's work. Just follow JC. It's ridiculous. He throws these charts up there that give you this idea of what's going on in the whole market. And it's just the behavior of the market. It's not this analysis. It's not this news story that you read where you have no idea what the expertise of the journalist who wrote the story, why they wrote it. Really, they're just trying to get clicks, but you don't know that. And so to me, it's a behavior thing. It's a simplicity thing.
That's where the data tell the story. The data is the story.
Data is the story, Michael.
Go ahead, but just quickly before the internet, journalists had to go read other people's articles, right? There was no way to connect these things. So, the death of journalism is not just because of clicks; it's because of workflow, right? Journalists, the only way, and journalists' lives used to be in way more danger because when they had to dig up stories and read past authors' stories to kind of piece together the story, real work had to be done. Well, why work if? So we had all kinds of newsletters in one National Enquirer, right? That's the way the world lived before the internet. Post-internet, everything's the National Enquirer, and we're still searching for our one true news outlet. So we've completely flipped that model. And in the mobile world, as it comes to finance, Robinhood and the copycats did a great thing, right? They onboarded hundreds of millions of new people to the idea of markets. The new lesson for those people that get over the hump is, how do I take that one screen and reverse engineer it so that I can learn what happened to give me that one screen? Because until they have a better view and zoom out of how the world works, they're going to be in the wrong stocks. And again, index exists for that, but I feel this next wave of investing is going to happen in the public markets, not in the private markets. So as bullish as I was on the private markets in 2010 in Web 2, I'm as bearish on the private markets. Not overall. Great VCs are going to have great returns. It's about the people you pick. But the returns are going to come. People are here. You have your Robinhood account. You can go build screens and go do that stuff and actually have liquidity in your investing portfolio by taking risk, by just expanding your worldview and understanding how investing works. Go ahead, Mike.
Just 2 points. Number one on JC and Howard, your point on tools, mobile to desktop. I'm old school Wall Street. I not only believe in desktop, but multiple screens. I've always had them. The big change in the last year or two, workflow-wise for me, is this element of voice AI. It's something I want to talk about a little bit later. I've recently just started to plug in just a separate screen with Claude and OpenAI on a voice basis. So now I can talk to it during the day, and it's popping up all kinds of charts, etc., without using keyboard. I'm mentioning this because it is helping me synthesize and extract charts and information 10 times faster than I could do it old days. It's the same kind of jump that when we went from desktop to mobile. So I just wanted to point out that those tools are coming, and they're going to be very, very much part of the mix in terms of making us more cognitive kings rather than cognitive misers to Phil's thing, because there's so much data, so many charts. And I agree with JC's charts. Just, I have 2 screens just with that stuff up there all the time from JC.
Well, it goes to Minority Report. The post Brad Feld and the best technologists have been saying to me forever is that we got to get past the keyboard. And I think voice is probably, and Ohm would say the voice is probably the thing that brings us back to the desktop, right? Like it allows you to have, we used to look at these Wall Street people and they had 8 screens and we made fun of them. Maybe that's the right way to do it. I don't think that's the right way to do it. I think in a world where Apple has these great display products, that 1 screen is enough. And I think voice may be what brings us back to the desktop. It's not going to be the keyboard. Kids don't love the keyboard. It works for people over 50 like myself. I'm very comfortable in my Apple display. I only do my work on a desktop because I don't want to wear 2-time magnifiers to do my research on my iPhone, and Siri sucks. So I think that's a good point. I think you're way ahead of the curve there in terms of how to make money on it. I think the way to make the best money in the market is not to be so far ahead of the curve, but to be, just in front of the curve where catalysts are happening. But yes, desktop and finance are back. People don't believe that because they don't want to do the work. For those people doing the work, which we're doing here, we're not asking other people to do the work. We're trying to do the work for you. This is what's happening. We should move on to the next topic, Phil, which is sentiment.
Let's talk about
let's talk about sentiment shift.
Oh yeah, the sentiment check. Why don't you throw that chart up there, if you don't mind, Kiki? That sentiment. What was it? The sentiment rebound. I was getting on with
JC
something
probably
else,
is following it. JC's
got
probably
it's sentiment reset.
The largest decrease in newsletter writers in bulls.
Yeah, that was
COVID.
amazing. So I think I shared that earlier. If Kiki or somebody can pull it up.
Slide 17. Yeah, there it is. Slide 17. Largest decrease in bulls since COVID 4 years ago on that pullback. And now the VIX is all the way back down. And, that just in my view, I have a emotional behavioral view of this. And that is that everybody is so jumpy and that there's so much emotional volatility that we're just, shoot first, ask questions later. Everybody reacts. Everybody reflexively, knee-jerk reacts emotionally to new information. And I think that is an opportunity for investors if they are calm during those crazy emotional moments. JC?
So this is a good data set because it goes back to the 1960s. So this was a gentleman who believed in the 1960s that if you take what all the newsletter writers are saying and they're all bullish, that's probably a good time to buy stocks. And if they're all bearish, you can aggregate that it's probably a good time to be selling stocks. As it turns out, it was the exact opposite. When all of the newsletter writers were bullish, it was actually a great time to be selling stocks, and vice versa. When the newsletter writers were bearish, it was a great time to be buying the stocks. And to kudos to the guy, I forget his name, like WD, like, how they had, like I forget the guy's name, but this is in the 1960s. And so to his credit, he quickly realized that it was the exact opposite. So started quickly using that as a contrarian indicator. So we're now in 2024. This data goes back 60 years. Like, that's a good data set. And so we haven't seen, so it tracks the bulls and the bears, and we haven't seen a decrease like this in the amount of bullish newsletter writers since COVID. The last time we saw this, we went on to see the greatest 52-week period in the history of the United States stock market, believe it or not, the last time that this happened. And Jim Bianco, shout out Jim Bianco, this is a 1-week rate of change. Bianco ran a 2-week rate of change. It was the largest 2-week rate of change since 1987, right? So shout out to Bianco, but nevertheless, telling you the same thing, running for the exit. So you got that sentiment reset, sentiment no longer the headwind that it was before. Now sentiment is back to where it usually is, right? Sentiment by definition is usually not at an extreme. It rarely is at an extreme. It's usually somewhere in the middle. And that's where we are now.
Yeah, and so the red is more tradable or more actionable to me than the green, right? So when you have the spikes like we have this last week is more of a tell than the complacency, that timing of complacency on the upside, right? Because they're both very hard to time, but I find that red spikes are much easier sentiment for me to understand. Why? Because investing is emotional, right? And it takes an event for people to realize that they were too happy, versus it's easy for anybody to read the bearishness news. Now, the other thing about newsletter, this is such a great thing, that's why I wanted to talk about it, is this doesn't factor in, again, going back to VC. A lot of these newsletter writers, including myself, I'm a venture capitalist first over a stock market investor, we are coming to realize the problems in our portfolio. And so that's bleeding over into a lot of these newsletter writers have private investments that they made at the peak, because they all chased. So this I think is, I can't prove this, quantify it, but every newsletter writer that writes about stocks is sitting on a bunch of private investments that continue to report terrible, we might be shutting down, we're doing an acqui-hire. So this bleeds into their sentiment, right? Because they're not no longer 100% just stocks, all these newsletter writers. They're people like me. Every Substack is written, every Substack financial writer has some seed stage investments or some growth stage investments. So the sentiment is really confusing to these people. And this is why they're bearish. They're bearish for the wrong reasons. They're bearish because their private portfolios suck. And, in crypto, what happened is everybody went liquid. So we invest in a lot of crypto funds. And all of a sudden, they started reporting that we're just going to buy Ethereum and Solana. I think you may see, Michael, some VCs start to change their docs and say, we're going to also buy Apple, or we're going to buy some tech company that's a 2 billion valuation that could be 10 billion valuation. This goes to our 2 to 100 thing. If your better odds are in a public company that's been underfollowed, you get liquidity, and it's kind of like a venture investing because it's been ignored. Why would you invest in a private company? So I do think what could drive, even though we're at high prices overall, relatively, people say, on valuation, there's still all this money misdirected in other markets that aren't reading the tea leaves of what's happening in the public markets, right? And, one last thing, and we'll move on to Baba. Phil, is JC was talking about new lows. VIX spiked to 60. There's nobody left to sell China, right? So in the new lows, you'd expect China to just keep going down. Well, it's stopped going down as well. So this is a sector that's just been a drag on the world for, 5 years, if we look at a Baba chart. So this goes to the other thing, is like, who's left to sell? And, maybe there's some selling and rotation on the good stuff, but the bad stuff stopped going down, it feels like.
I'll tell you what, if you go to that emerging market currencies chart, I think that this is an interesting story that nobody's talking about. EM currencies making new 3-year highs. I think that this is a big deal.
Do we have the chart?
Talking about this? Yeah, it's the CEW. So shout out to our friends over at Wisdom Tree. It's a great. Listen, it's evidence of risk appetite. It's not evidence of risk aversion. If these emerging market currencies are going up, and look at all of them. Look at them. Just this week alone, look at the Malaysian ringgit, the Polish zlotys making new 3-year highs. Look at you're talking about China. You're talking about these emerging markets. These are kind of like the ancillary areas. So you got the ringgit, you got the Philippine peso ripping, the Thai baht, Korean won. All of these things are acting really well. Like that is just not historically evidence of risk aversion for equities in general. Like you've got this yen carry sort of unwind taking place, and you got all these quote unquote scary things happening. But in the real market, in the big market, this $4 quadrillion Forex markets that's really driving things, we're seeing further evidence of risk appetite versus this tiny little nothing of a market that we call the US stock market that is only 50 trillion. Think about how much bigger the Forex markets are. So, as equity investors, which all of us here are, we want to think about, what the real daddy in the room is, and it's the Forex market. So I think it's important to think about what's happening in those markets and bring them back home into the U.S. equities market. And what we're seeing in those markets is not risk aversion. We're not seeing credit spreads in the fixed income market blowing out. We're not seeing these, risk on currencies falling apart in favor of the United States dollar. We're not seeing any of those things. Those are the types of things that you are likely to see in an environment where the new lows list is expanding. So in an environment where not only is the new highs list expanding, not only are the world's most important stock market indexes making new all-time highs, but the Forex markets are confirming that. They're not, it's not like a divergence. Like, well, why is that happening? No, it's all together. It's all the same thing.
Yeah, the economics. So the flip side of that chart is what we want to share is the US dollar chart. So gold's been running. Now we know why. It's not so much that foreign currencies are strong, it's that US dollar is weak. I mean, however you want to look at it, they're all tied together. Foreign currency strong, US dollar weak.
The US dollar is really just a mess.
A mess.
Which
weakening.
the stock market likes, right? The fact that and US 10-year yields have been messy too, right? Here you go. Look at Caleb. Shout out Caleb Franzen. He's pointing this out. I mean, this is just a sideways hot mess. And you know what? The stock market loves a lack of volatility in the Forex markets. This is like the perfect scenario. And guess what? Stocks have been going up while the dollar's been doing nothing.
Well, I think gold might be signaling a breakdown, meaning it could be wrong. Like gold may be running as speculators try and predict what that range breakdown there. But you're right. Okay, so if it's a good lesson there, I didn't know that terminology. Mike, you probably know more of this from Goldman, so chime in. But I guess if there's a mess in the US dollar, that's good for. If it's just choppy and a mess, that's good. Is that what you're saying, JC?
It's just not. It's just not bad. Right? Like what's bad is when there's massive volatility in the Forex markets, massive volatility in the fixed income markets. It's a lack of volatility and a lack of uncertainty there that the market likes best. So like this messy market, it's not so much that it's good, Howard. It's not bad. It's just not a problem, right?
Okay, go ahead, Mike.
JC, go ahead, Mike.
No, and a number of those countries that JC pointed out in terms of the currencies also recognize that there is a geopolitical reality of reshoring that's going on, which is a multi-year trend. Lot of removing of plants and manufacturing sources in a lot of the countries that you mentioned. So that has to play into the FX piece. Also, the growth of nomadic visas. Everyone is now a developer, etc. There's a huge amount of competition amongst a lot of these countries to attract talent to come into these countries and make things and build companies and so on. So these are all macro trends I would point out.
Why isn't the rupee? Why can't the rupee get going? Why is it just all of these are ripping? You got the Malaysian ringgit, Thai baht, Philippine peso, all absolutely ripping, and the rupee just can't get out of its own way. South African rand is going. All of them. Why not rupee?
Great question. India, they're just settling in from. It's a great question, JC. India is just settling in from their big election. That was basically a little bit of a disappointment to the Modi government. I think the tailwinds are going to be a little bit more pro India, and hopefully on the currency side as well. But I'm not an expert there. They are spending massive amounts to improve their infrastructure for exactly this reshoring thing that I'm talking about. Apple. 15% of the iPhones are now made in India. Their objective is to maybe double that over the next 3 or 4 years, moving it from China. The biggest bottlenecks are infrastructure, lack of ports, lack of roads, lack of power. And the Indian government is spending huge amounts of money. And so a lot of the investments, foreign investments, are also waiting for this infrastructure cycle to catch up, which is happening. I was just there in February. And almost every place, it's like cranes everywhere, etc. It's a massive build out that's going on, but it'll take time.
It's fascinating that in the stock market you have such an outlier of relative strength out of Indian equities versus other emerging market equities, and then in the Forex markets, you got the Indian Forex just can't get out of its own way. But even while all the other ones are ripping, like it's just a fascinating dynamic.
So what's the best way to own Indian stocks then? So as a professional, what's the best way to own Indian stocks?
Look at the ADRs. I think it's ADRs.
No, but like with US dollars or rupees? Like, I mean, the point is, like, are you getting bleeded if you own it with the wrong currency? So, I mean, who's making money here?
I don't like to overthink the currencies. I mean, unless it's a dramatic situation, like an Argentina or a Turkey or something like that. But like, don't overthink the currency that much. And then when you have the ability, like in Japan, for example, you've got EWJ and DXJ, so you can split that and take the currency equation out of the situation. So you just own the common. of Japan. India, you don't really have that, but it's less dramatic of the yen. So I think you just keep it simple, Howard. I mean, we talk about Indian ADRs here all the time.
Yeah, so on the sentiment side, oh, go ahead. So Phil, go ahead. But on the sentiment side, I was going to say the other thing that I've been talking about for months is the headlines are just going to get worse. And when the headline gets worse, people get paralyzed, right? And so they're not doing this basic math work of seeing why they're not double
That's been
clicking.
the case forever, and that's not going to stop. Perlman,
It's getting
right?
worse.
Like,
No,
headlines
no,
are
I'm not
worse
saying-
or what?
Ignore all headlines forever. Never
No,
read the news. Look at no headlines. Everything is noise.
It's not enough to say
Everything.
that. To double
I think
clicking
that's
on that.
where we are. I think
but
that's
it's
where we are in the
impossible to an
cycle.
extreme. It's impossible to ignore it all.
Gentlemen, what I'm saying is it's going to get worse. So unless people double click and build desktop visions of what the world really looks like, all they're going to see is the surface stuff, what's trending on Twitter and what's trending on Twitter, misdirection. Well, all I'm saying is, yes, don't read headlines, turn off CNBC News. That's not enough anymore is what I'm saying. We're in a post-mobile world for investing, meaning as we're seeing with currencies, as we're seeing with India, as we're seeing with AI, as we're seeing with healthcare and now cyber, this is not just own tech. There is going to be differentiators of the S&P and QQQ, as we've seen with semiconductors up 600% versus QQQ's 300%. That's a huge difference. That is no longer acceptable to just say I'm in QQQ. Like, I'm guilty of that. Like, in a world where that's starting to happen, even in an index world, there's nuances to what indexes are as people move money into the markets because the private markets, the relative trade sucks. So as people pour money or reallocate money from private to public markets, good or bad reason, it's just happening because of returns. People are going to have to get smarter. And I'm saying, so it's not just enough to not read headlines. You have to start building a strategy of how to look at the markets. Okay, so Phil, I interrupted you. What were you going to chime in there?
Let's take a look at some stocks. Let's take a look at hack ETF, some ETFs and some stocks. What's working? Hack ETF, cybersecurity. JC has a beautiful chart on this. What's going on here?
I mean, listen, this is just, if you look at the software index, it looks a lot like this. So this is just cybersecurity, which is like underneath the sort of umbrella of software in general, but it's kind of like its own thing. And I mean, this just looks really healthy. I mean, this looks like, you know, anywhere in tech that I could say that looks constructive, that has kind of paid its dues, if you will, versus something that has just started to pay its dues, like maybe like semis or something like that. You know, this is a different thing altogether. Technology is a big space. So these cyber names, and you know what's really fascinating? I'd love to hear your thoughts. I'm sure you've got opinions, both of you, especially Michael and Lindzon, that Palantir's not in there. So Palantir, there's slide 10. Take a look at that, doing really well. This one's, and then we'll get back to the Palo Alto because I know you guys wanted to talk about that. But there's Palantir making new multi-year highs, and then show Palo Alto, which obviously is in there, which looks great too.
Well, two things about this. Palantir's not in there. Maybe it's kind of like Uber wasn't in the transcripts. If you go back to the hack slide, two things that stand out to me. Where would this be if CrowdStrike, which was the darling, I don't know what percentage of it is. You can go to Koifin and search holdings. I'm sorry, I'm a little bit unprepared there. I'm just going to actually search that quickly right now. This is that performance is
Checkpoint is 4.4%.
No, CrowdStrike. Quickly, so that chart would be already be in a breakout mode because CrowdStrike's 4%. So that's down 50%. So again, Palo Alto's breaking out, which is helping the index. It's the largest position in that index. So sometimes you got to look at the components of this. But this would be much stronger if it wasn't for CrowdStrike and if Palantir was in here instead of some other small companies. So again, ETFs aren't perfect. You have to sometimes look below the surface. But I think this is hiding there's some underlying strength here that's not factored in. So sometimes you have to go into the securities themselves for hack. So I'm not sold so much on hack, but cyber. The other one would be healthcare. With J&J, right? Like XLV, which JC you've been talking about, which is probably going to be the next biggest beneficiary of AI and tech as we see it, right? You've got Intuitive Surgical, you got robotics companies, you got cancer companies, you got Eli Lilly, you have Merck. If we pull up XLV,
Yeah,
you
throw
know,
up the XLV.
you got
It's
United Healthcare.
Eli Lilly, United Healthcare, Johnson & Johnson, AbbVie, Merck, Thermo Fisher, Abbott Labs, Danaher, Amgen, Pfizer.
Yeah,
And then look at the
Pfizer's
equally
killing it.
weighted. Look at the
Yeah.
equally weighted. So the market cap weighted index is making new all-time highs. The equally weighted index is right in there, ready to rock and roll. This is a great example of not only the market is not going parabolic, there are actually a lot of areas in this market that have been paying their dues for years and are just getting going now. And here's the biggest thing, and I love this argument or discussion, and I'd love to hear your thoughts, guys. There's a quote unquote defensive tilt, arguably, in healthcare, right? Where it's more defensive. But healthcare is the second largest weighting in the Dow Jones Industrial Average, and it's the third largest weighting in the S&P 500. So while it might have somewhat of a defensive tilt, it has a large representation in the major U.S. indexes. It's the largest representation in Denmark, for example. It's like 23% or something like that. So, you know, healthcare can be risk on. It doesn't have to be like this totally defensive tilt. And when you look on an equally weighted basis, you know, I think that speaks to that.
You know,
Well-
you answered your question that you're asking right now the other day by posting the performance of the financials and industrials. And I thought that was so beautiful and kind of funny. I think that's slide 20, because you're like, is there anything bearish about financials and industrials closing at new all-time highs? And then you just throw that dumb, simple chart up there, 5-year charts of the XLF and the XLI, like no big deal. So when you look at, you know, an XLV and people are saying, well, that's kind of defensive or whatever, is there anything defensive about these guys breaking out right here?
Because you've got utilities making new 52-week highs, you have consumer staples making new 52-week highs, healthcare making all-time highs, real estate has closed at new 52-week highs like 3 weeks in a row. Is that defensive? When you go back and you study every bull market ever, you know what you're going to find? You're going to find that consumer staple stocks go up. You're going to find that utility stocks go up, healthcare go up, because they are stocks in a bull market. It's when those are the only stocks that are going up that is the problem. So if we see financials and industrials, to Perlman's point, it's not just those, because these over here are making new all-time highs also, you see. So it's not that it's just the defensive ones, it's that it's a bull market and there's a lot of different types of stocks that are making new highs. In fact, there are more stocks making new 52-week highs now than there have been at any point this entire bull market. So yeah, there are a lot of stocks going up.
Well, let's just let's pull up Health XLV again. This is what so you can't just have good price action. You need a catalyst, and so I've been trying to build a story, right? I have the degenerate economy, and you know, I don't love that name, but this is kind of more about the health conscious economy, right? And everybody's got coaches. Phil's a coach. We all want coaches because we now believe, right? After seeing successful people talk about psychiatry and coaches. So if we pull just the XLV up, what's the story here that people don't get? What's the catalyst? Well, the catalyst is probably not just Eli Lilly, but it's a combination of HIMSS, it's a combination of Manscaped, it's a combination of the degradation of retail drugstores, right? So the retail drugstores have been replaced with direct consumer marketing like HIMSS and like Manscaped, right? It's not just women that have, you know, a $100 product for every square centimeter of their body. Now it's men. Men weren't talking about this, from testosterone to manscaping to blue pills, right? So even though a lot
Every
of this
time
stuff
he says Manscaped, you take a swig, Perlman, right?
yeah. So
Yeah, it's a drink.
I didn't try and work it in, but what I'm saying
the
is
amount of manscaping coming out of Lindsay's
no, but I'm
mouth
getting.
is making me uncomfortable.
I don't go on Amazon, but I'm getting products from Manscaped every month, right? And soon that'll be all my male products. Okay. The other
You're
thing is
shaving his
Eli
balls.
Lilly.
That's like a nice,
But hang on.
polite way of saying you're shaving your balls.
Yes, but I'm also shaving my shoulders and my nose. So what I'm saying is, and now they have the dome, but XLV, there is, you know how much from Mark Cuban, and rightly so, you know how much we ripped the government and Pfizer and all these meds. So everybody's conditioned to not trust the drug companies. And that's playing out with Pfizer, which is the poster child for not trusting somebody because they were the ones that implanted chips when they were supposed to be fixing COVID, right?
Why can't this just be that there's just so much money going into the stock market? It's
There
a bull
is, but
market,
people-
and it's got to flow into healthcare because these are just huge companies.
No, I agree, but you have to also understand this catalyst. Before the fat pill, whatever it's called, Ozempic, we only distrusted drug companies. Now people are taking this pill for made up. They're hoping. We've gone from hating drug companies to maybe there is a miracle drug, right? Like Lilly had another drug for diabetes that came out today, right? So it's like there's this compounding effect of like people have changed their attitude towards drugs to not trusting drug companies to Jesus Christ. Maybe they got something right for once, and there is something that's better than this. So I think there is a catalyst
disagree.
for
I just got to say something. I could not disagree with this more. And the drug companies have won. You see 1,000 commercials. You turn on any golf, any football, any sports, any TV show, and all you see is one after the next of these pharma commercials. And what's going on here is that the pharma companies have won. They're going to make up drugs and come up with drugs for every single thing. You take a drug for, X, now you need another drug for the side effects of the drug you're taking for X. And then it's on and on ad infinitum. Here's the health play while we're talking about health care. Get yourself really healthy. Get yourself lean. Eat real food. Stay away from the middle of the supermarket where they have cereals and anything that comes in a box or a bag. Stay away from. Get yourself healthy. Move your body every day. And then guess what? You get into your 50s and you need 0 drugs. You don't need any of these drugs. You don't have to be. You could buy the stocks. I got no problem with that. But then you don't have to be a customer of these companies that are just feeding you one drug with side effects after another.
I think Phil has something, his finger on a very important point. The one thing we also, and we've talked about it a little bit, we should be looking at the demographic data as well. The young people are absolutely focused on health, living healthier, and they've been leading the way. Howard, you talk about, $100 per every square inch. Both men and women, young men and women, are buying all kinds of things and changing their routine to live better, look better, etc. And Phil's key point is I think spot on. Over the next 10 years, just like we had a megatrend in organics and in groceries and so on. I would not be surprised that one of the things that starts to catch hold is just reducing the number of pills people take over the next few years. That we wanted to live healthier. The technologies that we're talking about are allowing us to live healthier. We talked about the watch and all these AI things that are coming. The U.S. economy is unique among the developed countries in the world. We spend over 20% of our biggest GDP in the world on healthcare. Comparable numbers in Japan, South Korea, etc., less than 10%. Our system is totally geared to what Phil's talking about. Take a pill for the side effects of the pill. And the drug companies are absolutely winning. But that is going to, I think, potentially reverse because of healthier lifestyles.
I hope so, or it could get worse. Okay, let's look at Palo. Go ahead. Sorry.
I think we can move on to AI. So Palo Alto's breaking out. You guys are right, but you're also wrong. You're saying the same thing about people not double clicking beyond headlines. The good news is you're right, but 1% of people will follow this advice, no matter how much you give them, because the drug companies are shipping vapes. Philip Morris shipping, vapes.
Good point.
You got DraftKings shipping stuff that's like crushing young souls financially. So I'm talking about the catalyst, whether we like it or not, being the fact
Good
that
point.
no matter how much good advice you give people, the drug companies have figured out a new scam and they've gone direct, right? And there is nothing that people won't do, even people just 10 pounds overweight, to lose that last 10 pounds and then log on for $1,000 a month to us.
No,
that's
I
the
agree.
catalyst. That's the catalyst.
I'm just looking at macro trends like, today's young cohorts are drinking less. Alcohol consumption has gone
But
down.
they're vaping more.
They're vaping more,
which could be
correct.
more, which is more
Exactly.
addictive and
And
harder to get off of.
there
So,
are
for
more
example,
unknown. Go ahead.
my son Max came home this week and goes, "I'm done drinking." I go, "Why are you done drinking?" He goes, "Because I'm 25 and I had 6 drinks last night and I can't move today." Right now, he didn't throw out his vape, which is probably doing more damage to him than the one day of drinking. So I'm saying there's new vices that are hooking these kids.
New vices.
And if they figure out that Ozempic helps curb vaping, guess how many fucking college kids are going to turn to Ozempic? So I'm just saying there's a catalyst for this problem, and that is the drug companies, whether you like it or not. And I think Ozempic is the mobile phone. I'm just trying to say Ozempic is the platform that onboards 100 million new customers to drugs. That's it. Move on. Let's go to AI. 3 big stories, Mike, that Phil and I put together. There's the AMD purchase of $5 billion. There's Elon saying "fuck you" guardrails and allowing showing. It's pretty funny, but like gets boring pretty quickly of stupid photos you can put together. And then third is Google and Apple fighting over voice. So take it away.
I highlighted these 3 just for the broader trends they're underlining. The AMD acquisition of ZT for $5 billion is an accelerating trend for the entire chip business. We talk about chips as chips. We should be thinking about them as very dense, accelerated computing data center systems. What AMD is saying, we are going to need a lot more help. Our customers don't want to just buy the chips. They want us to assemble all of this stuff into computers and clusters that go in to their specifications, tailor-made to their specifications into the data centers. And that's what ZT Systems allows them to do. ZT also, by the way, does the same thing with NVIDIA chips. But now with this acquisition, you would presume most of this is going to be AMD systems. The one subtle thing I want to point out is people talk about AI destroying jobs. One of the things technology always does is creates entirely new categories of jobs that grow like weeds. About a year ago, it was prompt engineers. Everyone was hiring prompt engineers for hundreds of thousands of dollars. Today, it's data engineers. This is the new category. People who actually work staffing the data centers. We need hundreds of thousands of these people. And they're a combination of blue collar and white collar. They're paid 100,000 and up. AMD with this acquisition gets at least 1,000 data engineers. And why is this important? NVIDIA led the way. NVIDIA bought Mellanox. They're already deep into the data center assembly business. They're partnering with companies like Supermicro on the cooling side. I've written about that. Same thing with Dell, etc. So there's going to be a combination of these companies, the chip companies, going vertically integrated to build the data centers for themselves and their customers. So that's an important trend to watch. Second, on Elon, he is the number 4, number 5 large language model purveyor with Grok 2. And so he wants to figure out how to make a bit of noise and difference. He can afford, because of him and his personality, to ratchet down the guardrails on Grok 2 versus OpenAI, versus Google with Gemini, versus Anthropic with Claude. Those guys have to be much more careful on not allowing their LLMs to provide negative, unsafe pictures and results. Elon doesn't care as much. And so the reason this is interesting is that he is trying to use his Twitter and other platforms to get a distribution advantage. And it may have a reaction with the bigger guys to figure out how to manage that slider better if this thing starts to show traction for them.
Well, it's gonna show traction in the ways that I don't think makes. Again, this goes to him not understanding social. You can be a bully. I still don't think he understands social. He understands winning. If the game was get the most followers, get the most attention, he won. Trump, to the point where he was bored. He begged Trump to get back on the platform because it's boring being the king. Okay, so if he's already won, I think he's taking, again, the wrong stance here, because what's good for him is not good for everybody else. Creating, Trump kissing Kamala, as real as it looks, is good for memeing, is good for attention. it's not good for the soul, right? It's not funny, right? If it's just for clicks, right? Comedy and all this stuff and stuff that's truly good for the soul and for people is truth, right? And we're lacking this truth. I think it's a bad decision by him, but it's a series of bad decisions. Again, he doesn't care. It's his book. It's his platform. But like, what's your take on that? What would you rather see him do, Michael? Like, what's your
No,
take?
I would like him to be more centered on some of the issues that you're talking about. But that's he's not going to change. This is the stuff he loves. This is his version of fart jokes. He loves it. You know, he put them in his cars. He's putting it online. So I agree with you that this is most likely a short-term meme blip. But I pointed it out because all the others are overcorrecting on the guardrails to the point where you can't do interesting things, the creative things, not the raunchy and the negative things that Elon is doing on the political side, but just so there is a place on the slider, and I just point this out that there is a recalibration of the slider that needs to be thought through because of the regulatory.
As the king of social Trump has done to financial bankruptcy, I think Elon's doing to, he can't be financially bankrupt. He's going to be the richest guy in the world, right? Like, it just is. He's not, but he can't piss it away, right? Like, he's the most socially bankrupt. So I'm saying he continues to triple down on social bankruptcy. So as many bankruptcies as Trump has had financially, he's going to go down in history as the one with the most social bankruptcies. I mean, which is fine. Like, it's not costing him a dime to be a dick, right? Like, in his mind, his net worth keeps going up because of space and because of satellite internet. Twitter and Tesla are fucking rounding errors.
Yeah.
In and he's decided to use those two to fuck with people. So it's super interesting. So then the Apple, Google. So then the voice thing. Go ahead, let's finish off with
this
the voice.
This thing I just pointed out for a couple of reasons. Google announced Gemini Live, which is their voice version of their AI. And why is it important is because they are one of the unique companies to have the vertical data center compute infrastructure to roll this out, voice AI, available to hundreds of millions and billions of Google users. OpenAI had a version of this with Omni, which is GPT-4 Omni, but they're still ramping up their infrastructure through Microsoft Azure. So Google is kind of winning the race of getting this voice AI out there. And the reason I bring it up in the context of Apple is there is a lawsuit where Google lost, that there is the antitrust remedy phase that's going to come up, potentially breaking up Google, but I don't think it's going to go there. Probably resetting the deal between Google and Apple to adjust the $20 billion payment that Apple gets every year for making Google search the default. What I'm pointing out in this post is that voice AI competition between Google Gemini on one side and Apple with Siri on the other may be a bigger wedge than the regulatory remedial remedies that may break up the deal. Apple needs to as urgently dominate voice AI as Google does. And these are the two companies that uniquely have direct distribution to billions of users, unlike everybody else. So that's why it's an important development that I wanted to highlight. It'll take a couple of years to play out, but it's an important one to keep an eye on.
The master of AI hallucinations, the guru of AI hallucinations, Michael Parekh. It's hard this trend is the trend. Like, so of all the other trends, this is the trend. It's going to play out across industry from industrials to medical. So that's why we're seeing this bull market probably being broadening is AI applies to everything versus social media really applied to a few things. AI is this, and maybe even helps crypto. You know what I'm saying? So it's just AI is going to create bull markets in weird places. Speaking of bull markets in weird places, okay, so Riley, we have this product called Trends. JC, if you can hang on, I want to finish with the VC market because I know you're interested in it. But let's
go
get
right
to
that. Let's just talk about that one chart 22 really quickly, and then we'll do Riley. The startups are shutting down fast.
There's a few charts. So Mike and I were chatting about, like, venture capital is an incredible category. It's not going away. it's just going to have to quickly evolve, and it's not. People are playing the wrong playbook, right? And this JC goes to why the sentiment is not accurate, right? The stock market sentiment is accurate, but there's this bleed into market newsletters because they are part of this economy, this 4 million person economy, which is startups, right? And has been growing very fast. But this chart is brutal. The failure rate is increasing at a time when AI is helping the incumbents, right? So you have this triple whammy, double whammy, triple whammy going on where kids are frustrated, right? They went and got the wrong degree at Stanford. They're at schools that they can't attend their classes because of Zoom. They thought that was a smart thing to go work at a startup. And they really could have just gotten a regular job, put their savings in QQQ and SMH, and been, for the last 10 years, pretty much en masse further ahead of the curve. So we haven't seen this play out. I think this is the FT talking about this. Okay. Last week I went on the riff about like the bear market and venture capital. This is just some more data that I wanted to click on. Phil, FinTech Junkie, Kiki, if you could pull up FinTech Junkie, which is Frank Rotman. He's QAD, master investor, Capital One before. There's a couple threads that he has. This is the most important thread that really drives down why the last few 5-6 years are just a mess, right? And it has nothing to do with and pretty much you could blame it on ZERP, but you also have to blame it on the pace of allocation and the fact that ZERP changed and that the puck moved, right? AI came out of nowhere. Everybody's leaning into the wrong category at the wrong time. And so they're underexposed to AI. AI itself is being overinvested in at a pace that's insane. And so much money was raised, as Frank outlines in his tweet storm here, which I will share, but everybody should read. He explains the actual math. Like JC, you love this. Frank, who's a legendary investor, takes what I holistically see and feel in my industry and explains you the math of how VC investing works and what happened between 2020 and 2022. There was so much money raised and deployed so quickly that we're going to feel the unintended circumstances of the end of ZERP and the beginning of COVID. So for those that just think I'm riffing, there is data that goes behind this. Here's another thing. This goes to math. This goes to actual cash being distributed. Look at the distribution rates. Okay, this affects mood. When you're expecting to earn a certain amount from your private equity investments, or you time it, and that doesn't work out, trust me, it hurts a lot more than seeing the S&P down 20%. Because if it's down 20%, the S&P historically, is a good time to probably add. In the private markets, good luck responding to capital calls if you're forced to do capital calls when you see that the investments aren't working and there's lack of transparency. So you can see this, the unsmiley phase is the numbers are not going in the right direction, which goes to the mood of the stock market, right? People are under allocated to the stock market and over allocated to private markets. And that goes to the mood that people are seeing. It affects my mood because I'm very leveraged to venture capital. Okay. So I know there's a few other charts there, but there is data that supports the fact that liquidity is the place that's going to drive, right or wrong, it's what people are running to right now. We saw them run to money markets, and now we're going to see the possibility that they run to stocks much more than, and that's why the sentiment will eventually turn towards stocks. Okay, done with that. Riley, trends with no friends. Give us an idea or two.
Yeah, so today's Trends with No Friends name really touches on your degenerate economy. So we're going to go ahead and take a look at Flutter, who owns FanDuel, PokerStars, and about a dozen other gaming and gambling companies based out of Ireland. So Flutter reported earnings last week. The stock gapped up 8%. It's kind of knocking on the doors of making a higher high here. And since its earnings report has traded sideways, but I kind of want to bring Flutter into the context of DraftKings. We can see Flutter has 678 followers on StockTwits. DraftKings has 116,000 followers on StockTwits. One little caveat with this is Flutter didn't start trading on the New York Stock Exchange until late January. So kind of the newness of the security, I'm sure, plays a role of that lack of follower count. But then just looking at the internals of these companies, Flutter's monthly active users is at 14.3 million compared to DraftKings 3.1 million. And Flutter's market cap is more than double DraftKings. So much larger company, nobody cares. And we could see here on this chart, Flutter's outperformance since DraftKings, since the beginning of the year.
Do you have an account there?
No, but I also don't have a DraftKings account. I don't have a Caesars account. I don't have MGM. I don't have any of those.
Yeah, so we're not the market, but that is an interesting relative strength opportunity. The degen economist's raging. You know, Robinhood. I heard Vlad. I don't know if anybody listened to Vlad's interview with Patrick O'Shaughnessy, but it was it was the first time I've heard Vlad really dive deep on his background and as a public company. Really take the time with Patrick to. I recommend it to everybody because it helps explain some of the problems I have with Robinhood in terms of like letting me know why their strategy is what they are. They are the best positioned, true degenerate economy, front-facing company, despite the mistakes and certain lack of execution. I think you go listen to that. That would be a treat for people to kind of hear, take out your biases and just hear someone tell the story. It's pretty interesting. So I highly recommend that one.
Are we waiting for the world where you can bet on sports on Robinhood? Is that ever going to?
I don't know if they'll go there because they're so heavily, lawyers kind of control that company. But we're headed to a world where there's prop bets on everything, and I don't know if that comes through crypto or just through DraftKings or Coinbase. But UI will matter in a lot of this thing, and Robinhood pretty much owns that UI. If you go to Coinbase, it's a pretty complicated product. Right. First, you have to understand crypto. Then you got to understand whereas Robinhood's just so many people speak that language already that they probably are in the best position if someone's going to do that or acquire or sit back and acquire somebody. Okay, Phil, did we miss anything or we're good?
I just wanted to make one comment. This is Buzzkill Phil. I just wanted to make one comment on all of these gambling apps, not so much necessarily the degenerate economy as a whole, but the gambling apps. There's a new study that was just published by Baker et al., and it just goes to show that what they studied was how does participation in these gambling apps affect how much we invest in markets over time. So how much we're dollar cost averaging, how much we're automatically putting in to tax advantage accounts, or just investing at all in markets that have a positive expected value over time. And what they found is that participation in these apps and gambling in general on these apps dug in to the amount of money that we're investing for our long-term future. So this is affecting our sort of long-term wisdom behavior. You could think about wisdom on multiple time frames, right? So the time frame that is like the long-term time frame. And just one last part about that, it is affecting, as so many of the negatives in our culture do, it's affecting people with limited resources the most. So if you have a lot of money and you're throwing a little money in DraftKings, no big deal. But if you're limited,
tax,
it's progressive tax, exactly.
So this is the vaping of investing. It's the vaping of investing.
This is the vaping of investing.
Here's the thing, and I'm going to change the name of my ETF or my index. It's the degenerate economy is good and bad. Gambling's everything that's bad about the degenerate economy. There's nothing. Speculation in it as entertainment is great, but I think it's my job and it's our job to teach people that speculation of entertainment can be just as entertaining to speculate in a positive what do you call it? Positive Bill, what do you call it? Like
expected value.
Expectancy.
Positive expected value.
So if you're going to do speculation as entertainment, I'm going to remove first of all, I'm not bullish anymore on these gambling companies. This is just the first bit of data. The data is not going to get better. This is like smoking. every day that they dig deeper, they're going to realize this is poison, right? And okay, I'm not saying it should be illegal or legal. I'm going to say that like my vote is do everything you can to teach people if they want to speculate as entertainment. The markets are a fantastic place to do it with the right mentorship. Whereas going on Twitter and saying, I got a highlight guy on Twitter who has great inside information is just a waste of speculation as entertainment time. It's bad to generate economy. It's like good nude, bad nude. Generate economy should be embraced as a good thing. And I don't see anything good about what we're seeing in the data. So, all right, we'll end it on that. Thanks, everybody. Mike, thanks for
Thank you.
AI updates. Phil, Kiki,
Adios. Cheers, bro.
JC,
Thank
see
you all.
everybody.
See
See
ya.
you soon.